Alright, so ARIMA stands for Autoregressive Integrated Moving Average, and it represents a statistical time series forecasting method that combines autoregression with a moving average component. So the AR component, or the autoregressive component, breaks down the relationship between a current data point and past data points. The moving average component accounts for the influence of past forecast errors. The I in ARIMA stands for differencing, indicating that differencing is applied to the time series data to make it stationary before modeling, and we're going to talk a little bit about that next. So for differencing, it essentially means that we are detrending the data, i.e. we are removing the seasonality and other confounding variables. When stocks react dramatically to news, only to come crashing back down, or earnings only to come crashing back down. This is kind of what detrending means. We're removing those knee-jerk reactions and smoothing the data. So ARIMA does this by differencing, where the difference between each data point and the next one is calculated, effectively removing the linear trend. However, another approach is using a moving average. So when we're using moving averages, we are actually detrending data to an extent. We are smoothing the trend over a time period depending on the length of the moving average. You can take it a step further and use exponential smoothing to remove exponential growth trends. And another way that I see used in finance a lot, I don't use it personally, but I do see it used a lot, is through Fourier transform analysis. So if we want to just take a look at this, this is SPX, and we have three moving averages, or SMAs, the 50, the 100, and the 200. And we can see in response to the ups and downs and all arounds that SPX is doing over the days, the moving averages lag and sort of represent the overall trend. Now it's important to sort of visualize what this looks like, because this is essentially what ARIMA is doing. It is smoothing the trend and trying to isolate these ups and downs and just trying to ascertain what the overall direction is. So how do you perform your own ARIMA model? Well, the easiest way is to use an indicator that I created called SPTS, Statistical Package for the Trading Sciences. So we have it here. We're going to do it on the daily time frame from the October low to currently. We're going to go into our settings, open up ARIMA. We're going to change ARIMA type to SMA, and we're going to reduce the SMA length to 150 days, and we're going to select plot confidence bands. Then we're going to let it do its thing, and now we're going to see we have the ARIMA forecast for SPX over the next 150 days. Now over here we see we have our model performance, so we can see the significance is negative 0.71, which is very good. The R squared is 0.51, which is very good. It means it's explaining quite a lot of the variance within the price data. Our error is 415, which means that we have about a 415 range up and down from the moving average. So we can expect it to operate within a 415 point range of the moving average, which is currently around 3,500. And you can see that it's expecting on the daily time frame a move up. Now there's other ways we can use ARIMA modeling. We can use Excel to create an ARIMA model as they have a built-in forecasting function. So let's go take a look. So we're back on SPX. I'm going to flip to the 1 hour because I want to do an ARIMA model on the 1 hour, and I want to start it from our October low to present day as of the recording time. So we're going to export this data into an Excel using ISO time. Now that we've exported that, we can open it up into Excel. Now I'm going to, because I want to use it from the October low here, I'm going to go ahead and I'm going to remove all of the dates before the October low. So we're going to go ahead and I'm going to delete all of this. All right, so now we're left with the current data. So what we're going to have to do is we're going to take our close, we're going to copy it, we're going to open up a new tab in Excel, and we're going to paste the close in cell B. In cell A, we're going to put time. The Excel forecaster requires sequential time, so we're going to put sequential time here, just like that. And now we can go ahead and use the forecasting function in Excel. But because I just want to see how it is performing, I'm going to remove the last 4 data points so that we can just take, or 5 rather, just so we can take a look to see how the performance is. So we're going to highlight these. We're going to go up to the Data tab, and then we are going to go over to Forecast Sheet. We're going to click Create, and Excel is going to run an ARIMA forecast, just like we did in TradingView. So we can see this is our forecast with the projected price targets. It forecasts best and worst case scenario. So if we go down to take a look at the forecasted ranges, we can see where we currently are. So the expected forecasted range is in the first column, which we're seeing is around 4,341. And we have 2 other columns, the lower confidence and the upper confidence bound. So the forecast is the most likely forecasted result. The lower confidence is the worst case result. It's if we're going to continue downtrending, it's the values we would look at. And the upper confidence is the best case scenario. If we're going to continue uptrending, these are the results we would be looking for. So we should expect the value to fall between the lower confidence bound and the upper confidence bound. So let's take a look to see if that is indeed the case. So SPX left off at about 4,318-ish. So we're pretty close to 4,290. So let's go back to our results. And yeah, so we fell within this range perfectly. So 4,280, 4,402. We fell within the expected range of Excel's forecast model. So that is pretty good, you know, for Excel. I'm happy with it. So that is how you would do a basic ARIMA model with Excel. So how can we use ARIMA for trading? Well, besides simply predicting the price, we can see how over or under extended a stock is. So if we go back to SPTS, we reselect our settings. Let's do it over 100 days. What we're going to do is we're going to overlay the forecasted model with our chart. So we're going to plot the confidence bands. Now we're going to go ahead and we are going to go into the settings, the TradingView settings, and we're going to move this to the existing pane above. It's actually going to overlay our forecasting model with the actual chart. And so now we can see how SPX has been performing within the confines of the ARIMA model. And you can see it's been performing pretty optimally. When it gets outside of the range, it comes back in. When it goes below the range, it gets pulled back in. And right now we are re-entering the range, and the expected move is a continuation down before continuing back up down here. So this will permit us to sort of just see whether we are overextended or not. Now, other uses of the ARIMA forecast are for stock price predictions, of course, volatility analyses, and assessing seasonality. Those are commonly used by market makers and hedge funds when they're doing assessments on fair market values and those kind of things. And that is basically that. That's how you do an ARIMA, and that's all about ARIMA. So thanks for watching. Safe trades to all, and of course, leave your comments, questions below. Take care, everyone.